to the deep dive. Our mission today is, well, to cut through a lot of noise. We have a whole stack of sources covering global fiscal policy, market leverage.
All the way to the future of central bank independence.
Exactly. And we're going to break them down source by source to give you a real shortcut to understanding these major interconnected pressure points.
That's right. We're looking at shifts that could, completely redefine market risk, focusing on how policy is hitting these unprecedented levels of financial leverage.
Okay, so let's dive in. I think the best place to start is with the risk itself. Our first source is leverage. And the scale of risk-taking it describes is, well, it's pretty startling.
It is.
Get this. Traditional margin debt has already reached $1.2 trillion.
$1.2 trillion.
Yeah. And that figure actually exceeds the peaks we saw back in 2000 and even 2008.
And what's really fascinating here is how so much of this leverage is designed to, fly under the radar.
How so?
Well, we're seeing these leveraged ETFs, which let investors bypass the classic margin call risk. Their assets have doubled in just 2 years to $240 billion. It just reminds you of that old quote about the three L's, ladies, liquor and leverage. At the end of the day, leverage is always the core problem. It just magnifies everything.
And that private leverage is really being mirrored by some serious fiscal pressures on the government side. If we look at our next source, deficit breakdown, you can see that the U.S. fiscal situation is getting pretty intense. The October deficit alone hit over $284 billion.
And look, receipts were actually strong, but the sheer size of the outlays, that's the real structural issue here.
Right. And the big one is debt servicing.
The biggest one. Net interest payments took up almost $91 billion in that 1 month.
Which is a 27% increase from the year before.
Yeah, that's just an alarming rate.
Yeah.
And one other thing to note, customs duties fueled by the Trump tariffs hit a monthly record. If the Supreme Court strikes those down, that deficit picture gets worse, and it gets worse fast.
Shifting gears globally, let's look at Japan with the source, new plan, old habits. They're injecting a massive 21.3 trillion yen stimulus package.
Which is about 135 billion US dollars. It's huge. And it's meant to counter a recent GDP contraction.
But the source is pretty critical of the plan. Things like trying to increase births while cutting taxes.
It calls it pouring gasoline on a fire, especially with inflation already being so persistent in Japan. But the global risk is how they're going to fund all this.
Right.
To raise that much capital, Japan might have to sell off up to 11% of its U.S. Treasury holdings.
And that would have a massive impact on U.S. long-term yields.
So from government debt, let's pivot to something a bit more disruptive.
You mean crypto?
Exactly. Our next source is DAI and Bitcoin.
Okay, so we all know Bitcoin has these 4-year cycles. 2014, 2018, 2022 were all pretty rough. This source suggests the recent 30% drop might be tied to these things called DATs, or digital assets treasury companies.
Right, like MSTR. It's a company whose entire business model is basically to issue stock so it can hoard Bitcoin.
And here's where the structure gets really important.
Well, it's all about the structure.
Yeah.
Because these DAI companies are in major indices like the NASDAQ 100, passive funds are forced to own them.
But if they get kicked out, which MSCI is reviewing right now,
then those funds would be forced to liquidate. We're talking about a combined 1 million Bitcoin holding across these companies.
Which is 5% of the total supply.
A forced liquidation of that size would, without a doubt, hammer the price.
And that kind of structural risk is hanging over market sentiment, which we see in pause, or the beginning of the end. Despite high valuations and scary high leverage, that core belief that time in the market beats timing the market is still driving things.
And you can see it in some counterintuitive data. We just saw a record high put volume on the CBOE.
So people are buying protection.
Yes, but it's being read as a contrarian indicator. The buy the dip crowd sees it and thinks the retail traders are panicking, which means it's time to buy.
This whole market debate is colliding right with central bank policy. That brings us to round trip. The odds of a November Fed rate cut suddenly shot up from 30% to 78%.
All based on a new study and some comments from New York Fed President John Williams, who said there was, and I'm quoting, room for a further adjustment.
And if we connect that to our final source, The Chosen, things get even more interesting.
There's heavy speculation that Kevin Hassett, a former CEA chairman, is the front runner for the next Fed chair.
Hassett is famously critical of Powell's rate stance, and he favors aggressive cuts to prioritize growth.
Right, through tax cuts, deregulation, and big federal programs like the Genesis Project for AI infrastructure, the implication here is pretty clear.
Which is what, exactly, for you listening?
It implies a political desire for growth is starting to override the Fed's mandate to fight inflation. If growth becomes the main goal, the Fed's independence becomes secondary.
And historically, that leads to instability.
Higher inflation, higher long-term yields, and a lot more market volatility.
So, to wrap this all up for you, you now have a clearer view on the extreme market leverage, the huge fiscal moves in the US and Japan, and the intense pressure, both political and from the market, for immediate Fed rate cuts.
Yeah, the main takeaway is just how interconnected and, frankly, fragile this all is. Think about this.
Yeah.
If a decision by an index provider like with the DAD issue can force a massive asset liquidation, does that mean real pricing power is shifting away from central banks?
Shifting towards these passive investment structures.
Exactly. That's something for you to mull over.
Absolutely. Thank you for joining this deep dive.